Hi, and welcome to the chapter number 13 that is about accounting for the foreign currency transaction. So, what is the foreign currency transaction? We will try to understand that. What is the spot rate? What is the exchange rate? What is the functional rate? What is the difference between the functional currency and the presentation currency? Then, what we do with the foreign currency when we have many subsidiaries available internationally and we have to come up with one consolidated financial statement. On which amount we should record our transaction, what amount we should present in the financial statement, and a little bit more about the consolidated financial statement. So this is what we study in this lecture. So introduction. It means there are two general rules for the foreign currency. Number one is that all the debtors, creditor, or whatever the transaction you have done in the foreign currency, by the end of the year or at that time, you have to write down into your local currency domain. What that means, for example, I'm working in Malaysia, my company is in Malaysia. I might have many transactions in dollar, in ringgits, in dirhams, in dinars. So different currencies will be there because I'm an internationally working organization. So by the end of the year or at that particular date when you do the transaction, write down into the local currency rather than writing down in the foreign currency. And when you have a foreign subsidiary which you control, you can also write down that into a common currency exchange. Means if you are preparing for a consolidation and you have many subsidiaries which is spread all over the world and you want to come up with one financial report. So which currency you will choose? That's the question. So the chapter say that the standards say that you can choose that currency where your basic head office is, which is, for example, Malaysia in this case. And if I'm dealing with my material labor FOH are bought and sell in the Malaysian ringgit, so I should use Malaysian ringgit as the one currency, dominant currency, and should represent my consolidated financial statements. So what is the exchange rate? Exchange rate means the ratio for the two currencies like US dollar to RM. That's the exchange rate. I think you are quite familiar with this simple concept. Then what is the exchange rate for currently changes? There's a lot of change. Like, for example, today we have a dollar to Aussie dollar that was 4.444. Yesterday it was 4.445. A day before that it was 4.47. So there is a changes in the exchange rate almost every day. And now even hourly that has been also changed. So these are the few examples they have mentioned. You can read it through what are the different examples which is available. If you have a loan in foreign currency, if you have a transaction in the foreign currency, if you're a customer in foreign currency, how are you going to record? So that's what we do in this chapter. So entry of the data of the original transaction is we have to write down into the functional currency account rather than the spot rate. So a foreign currency transaction shall be recorded on the initial recognition of the functional currency. For example, my functional currencies over here is RM, Malaysian ringgit. So in this chapter, they use functional currency as a Aussie dollar because this book and the author is from Australia, so they use Aussie dollar as a functional currency. By applying the foreign currency amount, the spot exchange rate between the foreign currency and functional currency and the foreign currency at the date of the transaction. What do you mean? For example, I have a loan of 100,000 Aussie dollar and today rate is 4. So I have to record in my books at 400,000 because I'm working here. So my functional currency means my domestic currency should be RM rather than writing down 100,000 Aussie dollar. And it makes sense because that 100 Aussie dollar will not be 100 Aussie dollar tomorrow. They will be exchange I have to pay for. So there's a spot exchange rate, there's a functional currency definition, which is key term given in the definitions. Then they talk about the functional currency. What is a functional currency? How you think that this currency is my functional currency? Maybe I am Irani company working in Malaysia but dealing in US. So should I write down the Irani lira, Turkish lira, or should I write down Malaysian ringgit, or should I write down the Aussie dollar or the US dollar? So what is a functional currency? They give a definition when your material, labor, effort, or your sales are mostly dominated by a certain currency. That will be the functional currency. Like 99% of my sales are in Aussie dollar. Although I'm in Malaysia and I have dealing with RM. So since my 99% transaction is in Aussie dollar, so I will write down my dominant currency and the Aussie dollar and represent that financial statement. So the problem which we face in this, the two issues which is sorted out by this foreign currency standard. Number one is that the day you do the transaction, you have to write down in the functional currency. Second, by the end of the year, when you are representing your financial statement, you have to convert all the foreign transaction into the local currency or the functional currency over in this definition. And what is a functional currency? That is the amount which is influenced by my, I have paid to my labor, I have paid to my material, I have paid for my FOH, factory overhead. That currency will be my functional currency on which I will record my financial transaction as well as I will record my annual reports. And also they talk about the sales and the services, the currency which often used for that one. Presentation currency, that is a currency on which the financial statement have been presented. Normally the functional currencies is the presentation currencies, but sometime in case of a conglomerate, you have to decide. For what is meant by conglomerate? When there is a different consolidated financial statement. One company has a multinational company like Nestle. Nestle is all over the world, so they have many branches all over the world. So in the end, when they record all the transaction into one financial transaction, which of the amounts should we take? Because they have the branches all over the world, or KFC have branches all over the world, on which amount they should record. In the end, they decided we would record on the transaction of a functional currency which is available in our market. So same definition we have discussed earlier, we use here, and that will be the presentation of currency for the financial statements. Now, now they keep on discussing about the consolidated financial statements are prepared, transaction first translate into a functional currency, and then prior to the consolidation, the subsidiary financial statements will be translated into a group single presentation currency. Normally, when they make a consolidated financial statement, they try to come up with one figure only. You cannot have a multiple currencies in one financial statement, even if it's a consolidated one. Good question. There is a company who acquire goods on credit from a UK company. The transaction happened. The goods of sold is £200,000. Amount is paid unpaid until 30th June. On 1st June, the exchange rate was $1 to 0.5 pound. After 1 month of 30th June, that amount changes from 1 to 0.55 pound. So there is the buying power of the US dollar increase after a month, and we can get more pounds as compared to one Aussie dollar. Not Aussie dollar, US dollar. So how much we need to pay if we have a loan of 200,000? How much it affect to my currency, my amount? Do I need to pay something extra? So what we do, we convert that 200,000 into the amount of local currency, which is US dollar. So 200,000 divided by 0.5, so it becomes 400,000. So first of all, we record the inventory and whatever we need to pay on the 1st June, which is 400,000 US dollar. Then on the reporting period, there is an increase there is an increase or decrease in the transaction. So first day we have a 200,000 pound. Their rate was 0.5, so we need to pay 400,000. Correct. Same 200,000. Afterwards, its buying power increased from 0.5 to 0.55. 0.55. So here we need to adjust. So 0.55, once we divided it becomes 364 something something. You can check it out. So we kind of get a gain, and that gain will go to the profit loss. So whenever there is a difference in exchange rate from the day we do the contract until the year end or the presentation date, whenever that difference come up, any profit or gain from that fluctuation of the currency is considered as profit or loss, and it will be charged to the profit loss account. So that gain or loss on the exchange will be charged to the profit loss. That's the primary rule. Going further, now on the foreign exchange rate and the date of the adjustment, they say normally all the dates will be on the closing rate, that will be the spot rate. Foreign exchange needs some monetary items. It includes cash, interest, loans, swap, dividend, and few more debenture payables. They say all the assets, when they are recorded and when we go for the payment or when we present in the financial statement, any gain or the loss on that will be charged to the profit loss account. However, there are few exemptions to that general rule. Number one, it does not apply on qualifying asset. It means we cannot charge that into the profit loss, any gain or loss. What is a qualifying asset? Qualifying asset is that asset which has a useful life of more than 1 year in constructing. Like we enter into a contract of building a property, like the one we discussed earlier was CIP, that is a construction in progress. In that loan, any exchange rate difference will not be profit loss. It will charge to the cost of the asset rather than charging to the profit loss account. So that expense will be capitalized rather than charging to profit loss account. So that's a worth noting thing, that whenever there is a foreign exchange difference from the qualifying asset, we will charge it to the profit loss account. We charge it to the, will be added less it from the asset of the capital asset rather than we charge it to the profit loss account. And there is a certain hedging agreement, like we discussed earlier in the last video, that they can be a swaps or there will be a there will be a hedge of the fair value. There can be a hedge for the cash flow of investment. So that will not apply to this foreign currency transaction. Now, in this, they discuss the same thing which I discussed, a little bit more technical about number of issues we have. For example, with this foreign currency, number one is considering need to be given a currency in which the general purpose financial statement is prepared. If the entity is residing primarily within Australia, the exception is that the presentation currency will be Australian dollar. If you are in Australia, so if you are in Malaysia, we expect that you are working your financial statement into RM rather than any other currency. The presentation currency may not be the same as a functional currency. For the example, the parent residing in Australia, holding a subsidiary in South Africa. So for that subsidiary, they can have within the South African ringgit or rupees or whatever the currency they have. For that purpose of translation, the results from the Australian purpose, the presentation currency would be the Australian dollar. So head office can make an exception if your subsidiary is completely residing in other country and their major sales is in that particular country. They have paying their material labor effort for that currency in that country. So you can make an exception and you can present that report in their country, their currency rather than yours. Now, this is one of the example. There is a loan of 500,000. One of the company entered in the UK. There is a fluctuation in the exchange rate when they enter and when the exchange rate happen. The loan is for the 5 year and require a payment of interest at the 10% also on 30th June of every year. So in this example, they not only talk about the loan, but also talk about the interest you need to pay every year. So every year interest will also be fluctuated when there is a fluctuation in the exchange rate. So let's see how we're going to deal with the interest on the certain foreign exchange. So first of all, we receive a cash. Yeah, very simple, cash to whatever the foreign loan is. Then after a year, there is a fluctuation. You need to pay 10%. That's interest rate. That has been changed from 0.5 pound to 0.4 pound. And whatever the loan amount in the pound was, now it will be divided, the denominator will change from 0.5 to 0.4. And you need to pay interest of 125,000. So here is the interest entry, but according to 0.4 rather than 0.5. So worth noting this one. After a year, you need to record the loan payable. So currently you have a loss on the loan, which is a debit, a loss, and payable with credit for 250 because there is a reduction in the pound. Now you need to pay more dollar to get the same amount of pounds from the other company. Balance at the start was 1 million, and that balance has been changed to 1.25 million. So 250,000 will be the loan of this increase in the loan, which we consider as a loss. So you can see when the contract enter, and that contract has not only 1 year, but many years together. So the interest and the amount of the loan has to be charged into the profit loss account based on the fluctuation in the exchange rate. Now, they discuss about a simple translation of the monetary assets such as cash and deposit. Like the same principle will apply to all the money markets. So in the last, they discuss about what is qualifying assets. Qualifying assets are those assets when we do the borrowing of the assets, and that borrowing cost we have to pay. So for example, I am making a building or a property. I enter into the contract for more than 1 year, and I take a loan in the foreign currency, and every year I have to pay interest on that. So that interest in the foreign currency maybe fluctuate because there is a fluctuation in the amount in the exchange rate. So any loss or profit from that borrowing cost or that interest fluctuation, I will charge into the cost of the asset rather than charging into the profit loss account. Just like we did in the last question. So this is the question. They enter into a contract with some Singapore company, construction company. The amount is 500,000. 1 Aussie dollar at the start of July was 1.2, which will change to 1.1. So there is a reduction in Sing dollar. Now, what we need to do with this amount? Should we add up in the profit loss? Should we add up in the cost of the asset? So first, we take a plant for, and the account payable was for 1.2. Going back. This was 1.2 for the Aussie dollar. Now it changed after 1 year. So this was start of the building. We record on the plant, debit, payable, credit. After 1 year, when there is a difference in the exchange from 1.2 to 1.1, we compare it with this amount. So how much amount that has been increased or decreased. So once you can get a less Sing dollar as compared to 500,000, so 37,000 will be up more. Calculation is already given. So again, we do the same entry, plant to account payable, rather than charging to the profit loss account. The reason was very simple. This is a foreign transaction, and the foreign transaction for the qualifying asset should be entered into the cost of the asset rather than writing it down into the profit loss account. So that's what we do with the gain and the loss. And by the end of the chapter, they discuss about the swap. What are the different types of swap? Swap can be interest swap, can be loan swap. For example, there's a company A who has a loan in Australia. There's a company B who has a loan in Malaysia, and they know each other loan there. We need to pay to Malaysia in Malaysian company, is Australian company, and this is a Malaysian company who has to pay something in Australia to somebody else. So what they do, they swap. They say, you pay my loan, I pay your loan, because we are residing in the same country, so it's better for us. And we can enter into a loan swap agreement or the currency swap agreement. So given that, this is a little bit discussion about like once a company has a foreign currency loan, which causes loss of profit at the same time, then they can set off the loan of each other. So this is the discussion on the loan currency. There is no such a question in it. A little bit detail how the two parties can swap each other loan or interest or the payment. And that's pretty much it from this chapter. I hope you like this chapter. I will have more discussion in the next class. I talk to you later. Take care. Bye-bye.